Good afternoon, everyone, and welcome to today's webinar presentation, COVID-19 related impacts to financial markets, presented by the FEI Dallas chapter. Before we begin, I'd like to review a few housekeeping notes regarding the CPE credit offering today. We are offering 1 credit for today's presentation. To be eligible, you must answer 3 of the 4 polling questions and have a total viewing time of at least 50 minutes. Participants will receive CPE notification email when the credits are available. This typically takes between 7 and 10 business days. We are unable to grant CPE credit in cases where technical difficulty preclude eligibility. CPE program sponsored guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements as stated. In accordance with the standards of the National Registry of CPE Sponsors, CPE credit will be granted based on a 50-minute hour. And now I'd like to introduce Elizabeth French-Pospick. She's the Director of Baker Tilly and also FEI Dallas Chapter Special Events Chair. Welcome, Elizabeth.
Thank you, Nancy. And I want to say thank you to Nancy and Jackie for helping put all of this together. It's quite a bit of work getting all the bios and the slides in and putting it all together into the PowerPoint presentation, as well as getting the CPE all coordinated both before and after the event. So thank you so much for all the work. Appreciate it. And we wanted to say thank you to our sponsors, University of North Texas, and thank you to Judy DeLay for being our representative with FEI and supporting FEI. And I want to remind everybody how wonderful it is that we do have this wonderful college near our area that we have as a resource for students for hire when they're ready, for interns, for research, for all the different things that we can do. The professors are so happy when we can help them in their classes and support them. So please remember them in your business plans and all the different ways that we can support them and they can support us. So I'd like to introduce Stuart Gillen. Gillen is the chair of the finance at the University of North Texas for the college. He has so many experiences. I would waste the entire hour going through explaining everything that he can do. So I'm only going to give you a few highlights. He transferred here in June from the University of Georgia. He's an internationally recognized scholar in the field of corporate finance and corporate governance. His experience includes time as Associate Chief Economist as the United States SEC, the Senior Research Fellow with the TIAA-CREF Institute, and academic appointments at Texas Tech University, Arizona State University, the University of Delaware, University of Georgia, University of Hong Kong, University of Otago. I don't know if I'm spelling that right, but that's in New Zealand. He's also been a visiting scholar at 6 other national and international universities. Dr. Gillen is published in the Journal of Finance, Journal of Financial Economics, Review of Financial Studies, Journal of Risk and Insurance, and the Journal of Corporate Finance, among others. He is a prolific writer and has many associations and has won many awards, including the Financial Management Association International, the Indian School of Business Center for Analytical Finance, and the Western Financial Association. His teaching expertise includes corporate finance classes ranging from introductory to advanced, from all levels of undergraduate to MBA, part-time and full-time MBAs and EMBAs. His PhD is from the Graduate School of Business at the University of Texas at Austin. His Bachelor of Commerce with honors and a Master's of Commerce degrees are from the University of Otago. You're going to tell me how to say that one. I proudly introduce Dr. Stuart Gillen, and he will speak to us and start a wonderful presentation and introduce our other speakers. Thank you.
Thank you, Elizabeth. Wow, I was almost looking for somebody else to start talking here after that introduction. Thank you, it's very kind. So today, if we can move on to the next slide, I'm going to give just a couple of quick introductions to my colleagues who will be following after me. So Meredith Rhodes is an assistant professor in finance in the G. Brent Ryan College Business, the FEI department. She's had several years in financial services in particular working with volatility-based trading, and then she decided to come back to the bright side, so to speak, get her PhD, and now she's an up-and-coming star in our department, so we're happy to have her today. And then John McCary is Senior Director of the Murphy Center for Entrepreneurship in the college. He's got an extensive background in private equity and the corporate world around the globe, and he's going to speak on some of the private equity related issues. If we could go to the next slide. So I'm going to spend a little bit of time talking about some fairly high level corporate governance and strategy considerations, some directly related to COVID, some are coincident that have happened around this time that are also particularly important. I'll then transition to Meredith. She's going to focus on Fed and Treasury actions and how that affects cost of capital. And then after Meredith, we'll have John, who's going to focus on some of the evolving strategies of players in the private capital markets. So if we could have the next slide, please. And one more. Okay, so obviously we're in unprecedented times, and with unprecedented times and corporate behavior, there's unprecedented scrutiny of what companies are doing, both private, public. The political environment is very charged, so there's a lot of attention on a lot of different issues related to COVID. One of the things that has highlighted, I think, or come to the fore in the last few years is a very broad societal focus on, we just lost the slide there, so that's okay, on the role of companies and how their actions relate to the environment, to society as a whole, and in particular how different aspects of their corporate governance sort of affect both of those activities. So we've seen a great deal of increased attention, I think, to both corporate behavior and corporate performance. This comes from all arenas. It comes not just from the providers of capital, not just from investors. There's huge media focus on corporate activity. The regulators are scrutinizing corporate behavior, particularly when government programs involving funding and support are involved. The credit rating agencies are highlighting and are paying attention to what's going on. And this is not just public companies. There's a lot of emphasis on private companies, given that their dominant role in the US economy as well. If we could have the next slide. So I think that for anyone operating in the time of COVID, there are some common sense things that we need to do or need to keep in mind, and that is be aware of optics. So if you're working for a company or you're making the decision whether or not to take advantage of government support programs, for example, PPP loans or grants, be cognizant of what those were designed for, who the intent or the intended recipients were. There's been a lot of controversy in particular about larger companies and larger public companies who have reportedly taken PPP loans or grants when these were really designed for small business. So it's an issue that's going to attract a lot of scrutiny, and it's an issue that is also going to concern providers of capital. This is sort of indicative of the behavior of the corporate management. Some other issues that I think are very important to keep in mind, particularly if you're a publicly traded company, if there are any major announcements coming up of COVID-related business developments. So think a pharmaceutical company that's about to make it through stage 3 of trials. How that's managed, how that's disclosed to the public is very important. The SEC, Securities and Exchange Commission, has been investigating a number of companies for the nature and timing of their disclosures of this sort of information. So it's particularly important to have a well-managed strategy for disclosing value-relevant information as it pertains to COVID-related stuff in particular, given the environment. I have another bullet there, employee stock trading. So there has to be, I think, a lot of caution and reminding your employees and executives about what the constraints are when it comes to trading if you're a publicly traded company. If you're not a public firm, but you are working with a publicly traded company, then you also want to be careful about whether or not any trading activity on the part of your employees can potentially be construed as insider trading and bring with that legal liability. Again, this last one, timing and sizing of equity-based pay. Again, this is a little bit more on the public side because we don't see oftentimes what happens with compensation in private companies. But there have been sort of speculation that some executives have been getting very large option or equity-based compensation grants immediately prior to the announcement of very positive news related to COVID. So again, these kinds of things are going to get a lot of scrutiny, and they're things that we want to be careful of in terms of legal liabilities. Next slide, please. Some high-level capital market developments. My colleagues are going to talk sort of more detail about specific components of capital markets. And these are not really related to COVID per se, they're coincident changes. A number of regulatory changes from the Securities and Exchange Commission. So one is that the SEC has proposed opening up private equity funds and hedge funds to more investors. There used to be fairly tight constraints on what sorts of individual investors could contribute funds to these sorts of investments. They're opening that up. And so there are questions there as to whether or not that's going to increase a pool of capital for investment in both public and private firms. The flip side is, what are the implications for investors? There have been some arguments that these investments can be very opaque, not very liquid, and if you get unsophisticated investors in there, those can pose issues, and again, potential liability and lawsuits. Another thing that's happened fairly recently is that the New York Stock Exchange is developing and refining direct listing plans. That's just been approved by the SEC. NASDAQ's is in process. This is going to allow the potential for companies who want to get into the public markets to sidestep their traditional IPO process. Associated with that, or linked to that at least, is there's been increased SPAC activity recently. So special purpose acquisition companies. These are companies that go public, they raise a certain pool of funds, and they make a commitment to make a large acquisition within a certain period of time. And so the implication there is that if you're a private company looking to be sold, it might be a SPAC type investor that's willing to provide capital to you and get you into the public markets at the same time. Some other things I'm sure that we're all aware of. Bankruptcies are on the rise, particularly in certain industries. A lot of oil firms are having sort of financial difficulties these days. We've seen a large number of retail entities that have been struggling. The COVID has sort of tipped them over the edge. It doesn't necessarily mean that all of those companies are going out of business or liquidating. Some of these are restructuring, but again, it's an issue that's important to think about. If you're in the corporate world, if you're facing financial constraints, is bankruptcy an option? Related to that, the rating agencies, the credit rating agencies, they are much more willing now, I think, to downgrade. So as firms downgrade, that implies higher cost of capital. It has implications for your ability to raise funds. So managing and being cognizant of ratings triggers that bother the rating agencies is also something that I think is worth keeping an eye on. Next slide, please. So what are some general strategies? We're a few months into the COVID. I'm sure a number of you have been involved in these. The obvious things are, for liquidity purposes, there's got to be a focus on working capital, cutting unnecessary expenses, freezing hiring. Even in university settings, for example, there's been discussions about freezing hiring. A number of schools have had salary reductions. They're speculating that they will furlough employees to implement those sorts of reductions. We've obviously seen a lot of different companies initiating layoffs. So there's a lot of structural changes in the way that companies are spending on a day-to-day basis and dealing with employees. We, particularly in public firms again, have seen suspension of share repurchases, buybacks, and dividends, again, to conserve the cash to keep liquidity up. A number of companies have decided to freeze investment, sort of getting a little bit more extreme asset sales. So if you're in a position where you've got non-core assets and there are investors willing to buy those, that could be a way to sort of restructure the asset side of the balance sheet, raise capital at the same time, and assist with liquidity. Other issues there, debt restructuring. Okay, so bankruptcy is costly, and a lot of creditors are willing to negotiate to restructure beforehand. So restructuring debt is always an option, again, if you're facing financial constraints. And I do have here, I've mentioned a couple of times, strategic bankruptcy. So as I said earlier, not all bankruptcy is liquidation. It's an opportunity to restructure while protecting assets of the company. Obviously, that's not the best thing for shareholders, but if it's necessary for the survival of the business, then that's something that certainly a lot of companies are considering at this point. Okay, next slide, please. In terms of financing, some of the things to consider are alternative types of financing. You may or may not have been using these before. Factoring of receivables, so selling receivables, getting cash instead. Possibility of sale and lease back of assets. So if you've got warehouses, for example, perhaps those can be sold and leased back from the buyer, easing cash flow. Other types of securities, convertible preferred is sometimes an option. The leveraged loan market and high yield debt markets seem to be opening back up again. Again, cost of capital on those is going to be higher, but if it's a necessary, sort of necessary evil, then those markets are coming back online. And then the Federal Reserve, Fed facilities. So just a couple of the ones that are available depending on the type of company. The primary market corporate credit facility. So this is a program designed for investment grade firms where the Fed is willing to provide funds. The Main Street lending program, financially sound small to mid-sized firms that don't have capital market access. So there are different programs out there where the government is providing financial support, and again, being aware of those and what the options are and who's qualified is something that's worth considering in a great deal more detail if you're in need of funds. Next slide, please.
Stuart, I'm going to interrupt you because we do have a poll coming up. I'm
Yes.
going to launch that poll for you now and
Okay.
read that question for you. I'll give you a few seconds to answer this question. My business has considered accessing PPP funds, Main Street lending program, primary market corporate credit facility, more than one of the above, none of the above. Those are a lot of choices. Take a few seconds to consider your answer and don't forget to hit submit. And while you're doing that, I want to let everyone know that we're going to hold questions to the end because we do have a lot of material to get through. So when we get to the end of the program, we'll have question and answers. And if those question and answers are not, we don't have time for all of them, the speakers will get back to you. And there, I'm going to share those results. And that gives us something to talk about.
Okay, so that's pretty interesting, right? So, you know, a number of you have been exploring these different financing opportunities, and I think this is really an important aspect of the support that the government is providing. You know, these are very unusual times. You know, it's hopefully this is a relatively short-term event, but in order to protect businesses, in order to protect people's livelihoods, I think the federal government has done a lot of very positive things to support the economy as a whole. So I think that's interesting to see the spread of you who are taking advantage of those opportunities. Could we have the next slide, please? So longer term, it's a continuation of those issues that we had listed on the short term. Going forward, refinancing. Rates are at historical lows. The Fed seems to have committed to doing that, subject to the nature of the company you are, the risk. There may be opportunities for refinancing at lower cost debt. Also depends on the nature of the debt you have outstanding, whether there are covenant constraints that preclude you from refinancing, and there can be tax considerations also. But if cost of debt capital going forward, all else equal, is lower, then this is an opportunity to potentially, as those markets open up, to refinance. Two other things that I think are worth thinking about, and that is the so-called zombie firms, customers or suppliers. So the concern here is that the sort of downside of some of the government support is that companies that otherwise might fail, that arguably could be economically efficient for them to do so, get supported. I think the point there is that if you are in an environment where you have customers or suppliers that are potentially themselves financially constrained, then this is an opportunity for you to take a look and say, okay, strategically, what can we do? Do we have the ability to shift from those customer suppliers to others? At least be cognizant of the potential for those folks you're doing business with, that they may also in an extreme situation fail. Related to that, I think the ongoing relationship more generally with stakeholders of the firm, be it public, be it private, what are the relationships you have with your customers and suppliers? Can you work with them from a relationship perspective to ease payment timing, for example, ease some of those financial constraints? With employees, the concern for a lot of employees that they're being furloughed or they're potentially laid off. If in the short term, 18 months or so, business returns, are you going to be able to recruit back the employees that you need? At the end of the day, employees drive value, drive the business. And the same with providers of capital. Next slide, please. So longer term, continuing with this, I think overall we've seen a V-shaped stock market recovery. It looks that there's a bit of a disconnect from the economy as a whole. A lot of observers believe that there is going to be an economic recovery. It will hinge critically on a biological solution. So basically a vaccine or some sort of herd immunity. But we're also going to see structural change for a lot of industries, a lot of firms, a lot of individuals. There's a remaining concern that given this pandemic, is there another one around the corner? How do we prepare for that? So I think that at a broad level, this is an opportunity to assess our situation, think about business strategies, think about crisis response strategies, and keep monitoring on issues of environmental, social, and governance, and how the role that those factors in your company relate to both the business environment and society as a whole. So that's the conclusion of my high level. We're going to transition into Meredith. Meredith is going to focus on aspects of the Federal Reserve's response. Meredith, I'll hand off to you, and then you'll hand off.
All right. Thanks, Stu. So I'm going to talk about the Fed's response to COVID-19. So you normally think of the conventional methods that the Fed has, which is lowering Fed funds rates, lowering discount rates, or lowering or relaxing the reserve requirements. So all of that they've done during this time period. But additionally, what they've done is they've announced lending facilities to help support different aspects of the financial markets. And so they've launched a total of 9 different emergency lending facilities to the tune of about $2.3 trillion, and that's with a T. All of which are designed to support state and local governments who've been hit hard by the lockdowns, encourage bank lending, to kind of restore the functioning of the financial markets. We saw a huge dry up in liquidity, and so they injected a lot of liquidity to help those markets function again. And then they wanted to support the major employers of consumers and households, which would be the corporations and the small businesses. So what I'll do is focus on these last two. So next slide, please. And so to support the financial market function, the Fed actually brought back several of the programs that it used during the financial crisis of 07 and 08. So quantitative easing, basically the Fed's now able to buy government-sponsored mortgage-backed securities again to try to inject liquidity into the mortgage markets again to make credit more available for consumers, mortgage credit. For the money market mutual fund liquidity facilities, there was a constraint in liquidity for money market securities as these mutual funds tried to meet the demands of the investors who were taking their money out of these funds. And so the Fed injected liquidity into this market by saying to banks, if they bought these money market securities, they could use those securities as collateral for loans with the Fed. And so they were just trying to inject liquidity into the money markets so that it could restore proper functioning. And then the last one there is a primary dealer credit facility. Usually at times of stress, investors tend to steer clear of riskier assets. And dealers who are trying to make a market in these assets are holding inventory. And that inventory is costly for them. Their capital is in all this inventory. And so the Fed reached out to the security firms and basically said that they could use that inventory as collateral for loans to make it less costly for them to actually make markets in certain assets. So it would restore liquidity into these riskier assets. And so these three programs, really just the main function was to inject liquidity into these markets so that we could get credit flowing through these financial markets again. Next slide, please. To support business, they announced a lot of different facilities that they hadn't done in the past. So these are brand new. I'm going to focus on the last two bullet points first. So the commercial paper funding facility is basically the Fed buying commercial paper from corporations. So this is a major way that corporations fund their day-to-day operations. And so the Fed is essentially financing corporate operations. You want these markets to work because if they can't roll over their short-term debt, then these companies can't continue to operate. And this is a time in which we really need them to maintain capacity. As Stu mentioned, the Main Street Lending Program was really targeted for the small to medium-sized companies. These would be the companies that are too large for PPP money, but too small to receive support through the first two bullet points up there, the primary and secondary corporate credit facilities. And so really the target was, we wanted to extend credit to economically viable firms that were just financially constrained right now. They didn't have a lot of liquidity. And so they could go and get funds through this program with the Fed. And then the first two bullet points there is the primary market corporate credit facility and the secondary market corporate credit facility. Under these two programs, the Fed was really trying to support the corporate debt market. So with the primary market, the Fed was actually buying newly issued bonds from corporations or buying newly originated bank loans. And so the idea there was if no one else was there to buy the bonds, the Fed would step in and buy these. And so there would be a buyer ready to support these markets. With the secondary market facility, this was really supporting the liquidity in the corporate bond market. So as we'll see, there was a lot of distress early on as investors started selling corporate bonds. And so the Fed basically stepped in and said, we will buy existing bonds of corporations, either through an exchange traded fund or an ETF, or we'll just buy individual corporate bonds to try to increase the liquidity in this area. Next slide, please. So we're just gonna focus on those two corporate credit facilities here and the impact on public firms' corporate bonds. Next slide. So this is just kind of a picture of what was going on with the investment grade rated debt. And so this is Google, rated AA at the end of 2019. So a very safe company. It's not got a high probability of default. The blue circles there are the 6-year bond spreads over the treasury rate. And then the orange line there is the CDS spread of a 5-year contract. And this is typically a more liquid way of trading firms' default risk. And so these should move in tandem. As default risk increases, both the CDS spread and the bond spread should go up. But what you'll see here is that's not what's happening. Early in March, when the stock market started to decline, bond spreads started to increase slightly to show that there was an increase maybe in default risk. But then you see this giant spike March 23rd. And March 23rd is the announcement of those two credit facilities. And then you see that the giant spike quickly dissipated after that. But you don't see this in the CDS spread, which should be reflective of corporate fundamentals. So if there was a deterioration in credit with the firm, you should see it in the CDS market too, but we don't see it. And so this is suggesting that investors were selling safe bonds that typically trade at higher prices because they were trying to raise cash, maybe for some precautionary savings going into the pandemic. Since it's indeterminate duration, we don't know how long it's going to last. And so this isn't reflective of any credit problems. It's really just disruptions in the market. There's a lot of selling going on, and the market doesn't have enough liquidity underneath to actually absorb this. Next slide, please. And so some significant events, March 23rd, what we said is when the Fed announced those two credit facilities. More significantly for some of the companies was on April 9th. So this was an expansion of these two facilities, not only in size, so the amount of dollars, but in scope. And it's because of this fallen angel risk. And so these programs are targeting the investment grade rated firms. So these are the safest firms. But if a firm gets downgraded from investment grade to speculative grade, which is below BBB, there are some investors that will just have to sell because their portfolio says that they can't hold speculative grade debt. And so there's an additional risk here beyond just getting downgraded. So once you get downgraded, the prices of your bonds are going to fall and your spread's going to increase to reflect that increase in default probability. But if you downgraded from investment grade to speculative grade, there's additional price pressure on these bonds because of all that additional selling. And that's going to increase the cost of these debt, the bonds. And it's also going to create additional pressure on the rest of the high yield sector. And this is where you'll have probably the leveraged loans and the high yield bonds that are coming from those firms that are probably participating in the Main Street lending program. And so this is a huge problem if we do get a sudden downgrade of investment grade debt to speculative grade. But this announcement of this expansion actually said if you were rated investment grade as of March 22nd, and you've been downgraded since, and there is a lower cap on that, but if you've been downgraded since, you are still eligible under these two facilities, which is huge because even if they get downgraded, they still have access to credit under the primary market, and they also have the Fed supporting liquidity in their existing bonds. So that's going to alleviate some of that pressure that would have been on the high yield bond market if they had got downgraded without Fed support. Now, those first two dates are really just kind of verbal commitments. It wasn't until May and June that the Fed actually started buying. And we do see that the market did pay attention to when the Fed ended their verbal commitment and actually started buying corporate bonds, either through ETFs, which was in May, or buying individual bonds June 16th. Next slide, please. All right, so here I just kind of graphed spreads by issuer rating over time for you. So the unrated bonds are the purple dots, and they're kind of all over the place, which is what we can expect from firms where we really don't know what the default probability is for their debt. They're very sensitive to information and just kind of all over the place. Speculative grade, these are these junk bonds. They don't see a whole lot of variation early on in the pandemic. So the first date there would be January, and then the 126th, that last date would be June 30th. We don't see until about day 46, and that's going to be the day that the US declared a national emergency, that the speculative grade actually start to respond to a whole lot. And we see an increase, which we would expect if there were a lot of lockdowns that are prohibiting consumers from buying goods and services. But these aren't the companies that are eligible under these two corporate credit facilities. These would be the red and the blue lines. This is investment grade. And what I've done here is I've actually split it into the safer group, which is the AAA to the A rated. That's going to be the blue line. And then the triple B, which are the ones that are most vulnerable to a cash flow shock from COVID-19. So the reductions on the top line of the income statement with the revenue, these are going to be the ones that are most likely to get downgraded into that speculative grade debt. Now, investment grade is a huge portion of the corporate bond market. As of 2019, there was about $8 trillion in this market, which is about 47% of US GDP, which is pretty massive. But 50% of that is triple B rated. So you have this, what's considered safe in investment grade, but half of it is in the riskiest tier. And if we get a sudden downgrade without Fed intervention, that can put big pressures on the lower rated debt, which can have severe financial stability implications if we're not careful. Next slide, please.
Thank you, Meredith. I think I'll push the second poll to our audience. This is the second poll, and I'll read it to you. The amount of investment grade corporate debt that is rated BBB concerns me, especially in light of the COVID-19. I'll give you just a few seconds to answer that. Okay, I'm going to stop that poll, so hit your submit button. And I'd like to share those results. There you go.
Interesting. Yeah, I would expect a lot of people have been concerned about this because over the last 3 years, there's been concerns of a triple B bubble, which is talking about just exactly this. So interesting. So next slide. So here I just kind of zoomed in on those two groups. You can see the spread difference early on isn't that big, but as we move through the health crisis, the spread gets much larger. And I'll talk about the different announcements and the reactions in the next few slides. So next slide. All right, so corporate flexibility did seem to matter a whole lot with the market reaction during this time. This is financial flexibility, so the ability to get cash, so have liquidity on hand, and also operating flexibility, which is the ability to adjust some operating expenses so that you can kind of save on that and be able to meet your debt obligations later on. So at the onset of the crisis, a lot of companies that had undrawn lines of credit actually started drawing down those lines to increase their cash holdings, what's called a dash for cash. This was all companies, all ratings. But upon the announcement on March 23rd, the high quality companies, so that AAA to A group, they actually switched to the capital markets to start raising cash again. So remember, this is just a verbal commitment from the Fed. There's nothing backing it, but it was enough to unfreeze these markets where they could tap those markets, the capital markets, and raise cash. But the triple B had a harder time raising money in the capital markets, so they continued to draw down their lines of credit. But one tool that they did have is operating flexibility. They could adjust their R&D, their staffing, their SG&A, all these expenses to try to free up cash flow so that they could continue to meet those operating or to those debt obligations. Next slide. Actually, skip this one. It's just showing the lines being drawn down. Okay. So this is kind of splitting now the two groups into those with a lot of cash on hand after we've subtracted their current debt that's due. And so that's called a high liquidity firm versus a low liquidity firm that doesn't have a lot of cash on hand. So you can see with the safe group is liquidity did seem to matter just a little bit, especially after the Fed made their first announcement, which is that first dotted line. The spreads were a little bit higher for the low liquidity group, but it's that triple B that has that risk of being downgraded and becoming a fallen angel that this really seemed to matter. The market reacted more strongly to those firms that did not have a lot of cash on their hands. So they had higher spreads. That's going to be that dark red lines. But you can see upon the expansion announcement, which is that second line, we see a huge decline in spreads for this group. And that's because even if they get downgraded, they're still going to be eligible to tap those markets under those facilities. Between the verbal announcement on day 71 through 91, when the Fed started buying, you don't see a whole lot of movement in these low liquidity firms. And that's because the market is actually waiting for the Fed to do something. Once the Fed starts buying, which is those last two lines, you see that the spread difference between high flexibility and low, or high liquidity and low liquidity actually declines. And that's because the market doesn't seem to care anymore, because the Fed is actually doing what they verbally committed to. Next slide. But operational flexibility mattered a whole lot more to the market in regards to the triple-B. So the safe group, this doesn't matter at all, but you can see that once the Fed made its announcement, those with high or low operating flexibility, so they can't adjust their costs very much, they didn't seem to decline a whole lot. They kind of held up there until the announcement, and then those spreads dropped. But there's still a huge space between the spreads for those high liquidity and low liquidity. And that's because the market does seem to think that there needs to be an additional tool in the corporation's toolbox to weather this storm, because we don't know how long it's going to last, even with the Fed backing it up. Now, the spreads have declined since we started buying individual bonds, but there still does seem to be a difference between the two. And so I guess the bottom line here is, without the Fed support, financial flexibility and operational flexibility would seem to matter a whole lot more. The Fed has extended these programs through the end of the year. So maybe after year end, we'll start to see that operating flexibility does seem to really matter for a corporate cost of debt moving forward. And now I think John is going to finish it up with the impact in the private equity markets.
Excellent. Thank you, Meredith. Appreciate that. So what we're going to do is start with valuation and investments. This will give a good overview of where things stand right now from a fund manager's perspective. And obviously, this has impact on decisions that they make, as well as investor decisions as they relate to potentially investing with certain fund managers. So I myself have actually gone through this. This will be the third downturn I've been through, unfortunately. This time a little less painful for myself, being that I spend a little bit more time now with university. So typically what happens during periods like this is that valuations tend to get compressed, which tends to be a little bit odd considering that valuations usually in private markets tend to be a bit more sticky. I would restrict this to private equity, venture, real estate. Most of the valuations with these assets tends to be relatively sticky over a period of time, and a lot of that just has to do with a limited amount of information that's available. And so evaluations are usually done on these investments on an annual basis whenever they're reported. But it's not like a typical public market where you'd be able to look at a quote and get a general valuation at that moment in time. One particular impact that is having a important impact on in the market is the amount of dry powder floating around. Dry powder would typically refer to amount of capital that has been raised but not deployed. So I believe just within private equity itself, there's around $1.5 trillion that's actually been raised from institutional investors over the last, I would probably say, 4 to 5 years. That's effectively just kind of sitting on the sidelines. This really starts to create a massive overhang in the market. And so what you end up having is that, especially when they go into a downturn, you would think that that would be the appropriate time to start making investments. But what ends up happening is that venture firms themselves tend to become a little bit more conservative, and that's understandable in some cases. It's very hard to tell where the light at the end of the tunnel is. But as a result, less capital has ended up being deployed, specifically as it pertains to new deals. Next slide. And so what ends up happening is that portfolio companies themselves, because they don't have access to capital specifically from their funding partners, their investors, they in turn start to become a little bit more cautious. They will in turn reduce their burn rates, increase layoffs. They'll cut back on expansion plans. So you'll see this quite similarly in a lot of public companies, but you would say that it was, it's most likely, I would say it's the impact is more greatly felt, specifically in the private market, because there's just, there's only so many places that you can go for supportive capital. Late stage, so this in turn, so next bullet point on that, late stage VC deals are outpacing early stage in Q2. Coming back to the point that I had mentioned previously, and a lot of this just has to do with fund managers wanting to participate in known commodities, as opposed to going into something that's coming down the pipeline that looks interesting but just doesn't have a proven market. Or needs a ton of growth before it can be able to have a material impact in terms of generating investment return. So as a result, first-time financings are going to fall, and that would include both venture capital as well as private equity. Next slide.
Thank you, John. I'm going to interrupt you briefly for our third polling question for our audience. That question's on your screen now. My access to operational and growth capital now versus last year has increased, remained unchanged, decreased, none of the above. I'll give you a few more seconds to answer that. And if you're almost ready, hit those submit buttons. Okay, I'm going to end that poll and I'm going to share those results. And there are your results. Thank you, Jim.
Excellent. All right, perfect. So this brings us to fundraising. This is specifically when I'm speaking more from a fund manager's perspective in regards to fundraising. And this is a trend that's unfortunately been happening, I would say, over the last 10 years. But I believe, from what I can see from the data points that have been coming through over the last couple of quarters, the COVID impact has essentially just accelerated this process. So what's ended up happening is that some of the quote unquote blue chip or top quartile managers have effectively increased the fund sizes that they've been putting out in the market. And so what you end up having is you have these mega funds that have been effectively dragging the average fund size higher. But the mega funds themselves, the number of them has not changed. It's more that they've effectively just increased their fund size dramatically. The irony in this is typically, historically, I would say, the best return, quote unquote, best returns that you would statistically see in the market would tend to come from small to mid-sized managers, not mega funds. And a lot of that has to do with the fact that mega funds themselves, because of the sheer volume or the amount of capital that they have to deploy, they tend to chase very few deals, which means that the price they pay, they're competing with one another to get into these deals, which actually drives up the price. So there's really no negotiation power, as a result. And so the return they end up getting is substantially less than what you would receive if you're positioning yourself as a small to mid-sized fund. Obviously, the risk should decrease over that period of time, but if we're just talking about gross returns, then there would be pretty much a fairly large dislocation between the two strategies. Next slide. So, as I alluded to before, there is a fairly large overhang in the market right now with dry powder, and this is going to create a massive drag. And so, and this is something that I myself, as well as some other people in the market, have been effectively waiting to happen. What you end up getting is because fund managers themselves are incentivized to deploy capital, they are quickly coming up against a roadblock where they're going to actually have to make a decision whether they return capital effectively, whether they do not deploy capital, or they decide that they're not going to make a drawdown from their investor base to deploy capital. And in any regards, what the problem with this is that that if that money is not deployed, obviously the fund manager does not get paid, and so raising a mega fund, raising a multi-billion-dollar fund is just in name only, and there are certain fees and expenses associated with that. And so the problem that may start to arise, and this is highlighted really in the second bullet point, is that there is potential for negative returns to start to occur because fund managers right now are actually incentivized to deploy capital, and they may be deploying capital into to deals that don't suit investors. Next slide.
Thank you, John. I'm going to launch our last poll for our audience now. This is number 4. My business has made the following adjustments. Your choices are, salary cuts and or layoffs, cut back expansion plans, decided to seek an exit, filed for reorganization or closed, more than one of the above, none of the above. Those are a lot of choices. Hopefully I read them slowly enough so that you could get your answers in. Couple more seconds and we'll call it a day for polls. Okay, I'm going to launch those results. Interesting. Thank you, John. And you can finish up.
Excellent. All right, so exit environment, moving on to exit environments. So ideally what we're going to see, and this is, a lot of this is just, just some background information on what's been happening over the last year or so. The exit environment itself is not expected to be too terribly healthy. It looks like over probably the next 6 to 9 months. A lot of this has to do with just sheer uncertainty in the market. Also, there is a lot of uncertainty, in regards to whether or not the M&A market's actually going to be there as a potential exit option, or whether or not the IPO market will be there. This is one reason why SPACs have become fairly popular more recently with private companies. But one of the other opportunities that I've dealt with in the past is primarily the secondary private equity space. And while granted, a lot of those, I myself have had success in the secondary private equity space, where you would typically buy from a distressed investor in an opportunity, and the holding period would typically be anywhere from 3 to 5 years. Because you buy at a discount, you would be able to make that up fairly fast. The issue with this, though, is that most investors right now are not short on cash. And so the holding pattern in and of itself has created an environment where nobody has, I think we're still going through that. And as the poll kind of showed that, some layoffs and some salary cuts. And so a lot of businesses have been cutting back here and there. But really, no investor has actually decided to, or at least as far as I've seen, decided to make an exit at a discount yet. Now, if this is to continue over another year or so, obviously that trend may change, and you would effectively, based on past events, we would expect that the exit environment would, essentially dry up completely. Next slide. So, as you can see from the first bullet point, really not, the numbers speak for themselves. Not necessarily the best environment, but again, as I stated before, I think what we're effectively seeing is just a lot of a wait and see approach, and if the market starts to come back, and there is some type of therapeutic or breakthrough that occurs with COVID later this year, I would expect that this would change. But if not, as we head into next year, my assumption based on, like I said, previous experience and previous trends, would be that a lot of investors would seek an exit through secondary markets at that time. Next. Excellent. So, as I mentioned before, there was some positive momentum around SPACs. But as it says, and I believe as a couple of the speakers have mentioned, before myself, that a lot of the recovery, specifically when it comes to public equity prices, is, or at least the information being provided, tends to show that a lot of this may be driven by government stimulus rather than actual underlying fundamentals. And so as a result, what you're going to end up having is a lot of the private companies will continue to stay private and delay in potential exit. And as a result, they will be leaning more and more on their shareholders. And this will have an impact on decisions that the shareholders have to make and the fund managers themselves. Next. That's it.
Thank you, everyone. We're at the Q&A portion now, and I believe we have a question. Can you please elaborate on the New York Stock Exchange direct listing plan?
Yes, can you hear me?
I can.
Okay, I will take that. So this is fairly new. I think this was approved last week. So historically, companies, there are a very small number of companies like Spotify have done a direct listing on the exchange where they bypass the traditional underwriting process, but they could only sell existing shares. They couldn't raise capital. And the proposed rule, and again, I think the devil's going to be in the details, mainly for larger companies, values between 100 and 250 million, depending on how, what their background is, whether they've had private shares trading. And the idea is that they will be able to raise capital at the same time that they list on the exchange. And so there'll be an auction process to that. Some of the advantages or potential advantages is to sidestep the traditional IPO underwriting process. You wouldn't need to use the investment banks. You save the 7% commission. Typically, underwriters also have a lockup period of about 180 days that precludes insiders from selling that would not necessarily hold. So I think it's just a new process that is going to allow sort of relatively large, profitable companies to enter the public domains without going through that traditional underwriting process.
Thank you. Are there any other questions? We are at the top of the hour. We want to be mindful of your time. It seems we have no more questions. Elizabeth?
I think I saw, Elizabeth, did you have a question?
Yeah, a lot of the companies were requesting PPP funds, even if they had access to lines of credit, because they were afraid that they would not get those funds because they were afraid there was going to be a run on the lines of credits early on. They didn't know what was going to happen in the future. Is when the feds are determining need, can they use that as one of the reasons for a need for PPP funds when they might have had line of credit ability?
So I mean, let me take a first shot. Meredith might have more insights on this. My impression is that so long as those PPP funds are being used for certain expenses like payroll, utilities, rent, mortgage, the underlying rationale doesn't, I think, apply for the application. So long as they're being applied to certain things and that can be shown, I think that the companies are okay.
Good. Well, thank you all so very much. I totally appreciate it. I know Nancy has a couple of announcements at the end, but we really appreciate the University of North Texas and your participation in this event.
Thank you.
Thank you for having us.
Yeah, thank you.
I just wanted to point out that our emails are there. If any of the audience wants to ping us individual, please feel free to do so.
Excellent. Thank you, everyone, for your participation during today's webcast. As I said in the beginning, CPE notification email will be sent between 7 and 10 business days. My email address is on the screen now. If you have any CPE questions or difficulties during this presentation, just send me an email and let me know. I would like to again thank the presenters today for their knowledge and sharing of their talents. And as of now, this does end the webcast, and we do hope you have a great evening. Thank you. Bye.
Thank you.